I don't think having a job is wealth building. Even if you're a doctor, I don't think that's wealth building, that's income. That's just day to day. It's maintaining your standard of, even if you're a doctor, well, you probably have a nice car, you got a nice house, you got nice vacations. That's not wealth building. That's just monthly. That's living. Welcome back to Own the Exit. Aaron Leatherdale here. In this business, especially online, you see a lot of noise about jumping straight into complex real estate deals, alternative investments, chasing yield, passive income, all the stuff, the sexy stuff, right? People want to skip ahead to building massive wealth through investments. Nothing wrong with wanting to do that, but I want to talk to you today about the critical, often overlooked foundation that you must build first. It's not glamorous, but skipping it is like trying to build a skyscraper on sand, right? We're talking about the sequence. Earn, secure, then invest. Get this wrong, and even the best investment strategy can crumble under personal or business pressure. So let's break down the 3 non-negotiable steps to setting yourself up for sustainable, long-term wealth creation, the kind that lets you truly own your exit, whatever that looks like for you. All right, step 1. Maximize your primary income engine, right? So this is whether it's a W-2 job, whether it's a business, getting that step locked down and making as much income as you possibly can is the key first step, right? There's always going to be a limit on how much you can make when it's your hours, right? Like even if you're making $1,000 an hour, there's only 40 hours a week. Maybe you work 80 hours a week, but there's still going to be that cap because it's active income. But there's nothing wrong with active income. I think that active income is actually the first step. I think that there's a lot of virtue in that. It's skills development. It's expanding your mind, expanding your network. If you have a business, it's leveraging other employees, but it's active income. It's saying, hey, I'm not going to shortcut the process and try to jump to step 2 or 3 without first having step 1 locked down. And I just think about this. I was having a conversation with somebody earlier today about the pendulum swing. The kind of the old way of thinking was you go to school, you get good grades, go to college, get a degree, work for a good company, work your way up the corporate ladder, right? And then be throwing money into your retirement. And when you're 65, hey, you can go and enjoy the rest of your life golfing. And it's the American dream. And it's what's touted as like the safe, kind of normal conservative path that you should take. Lately, there's been, by lately, I just mean over the last few years that I've been seeing more and more of this passive income, this W-2 jobs are evil. Buy back your time, location freedom, financial freedom. I'm not going to be anybody's slave. All these things of like completely swinging to the other side where it's like everything's just going to be passive income. I'm going to be laying on a beach in Thailand. I'm going to be going on cruises all over the world, and my investments are just paying me, and I'm not doing any work. Work is bad. And I think that can go the other way, but I do think there's kind of wisdom and truth to both sides where I think there's a balance of good active work, but then also having a vision for having passive income and having time freedom and location freedom and different things like that. But it takes time, I think, to build that properly. And I think it takes time to build that foundation. And step 1, that active income, if you're a doctor, be the best doctor that you can be, right? Specialize, make as much money as you can per hour of your output. If you have a business, make that business the best that it can be. And I think you should do that before you even start thinking about alternative investments and how to have this passive income and how to put money into some of these other deals. And I'll get into the reasons why I think that. But I think that focusing in on step 1, and a lot of times it's not sexy, right? It's boring. It's work. It's hours of output for money. But I think it's important to get that primary income engine going. Now, step 2, build Fort Knox. So I just view that as cash reserves. Dave Ramsey says this too. You guys are all familiar with Dave Ramsey. I love a lot of his stuff when it comes to personal finances. He has his baby steps. right? And you can't shortcut it. You have to do the steps in order. And I think it's actually really cool, the steps that he has. And I think he says having these 6 months of reserves for your personal life. And that's step 2. I think you should do that before you start going into all these alternative investments and everything. I think you need to have your own life secured. And if you have a business, maybe you need $1 million for your reserve, 6 months of reserves or whatever. There's no formula. It's just whatever your business is and your cash flow needs are for that business, the industry you're in, your own risk tolerance, things like that. If it's a business, if it's a W-2 job, I think 6 months of income is great. If you're making $50,000 a year, having $25,000 sitting in your account, you're not trying to invest that. You're not getting a return off of it. The goal isn't to make money off that. That step 2 is not wealth building. And that's okay. It's not, oh, that money's just sitting there. That's the point. That $25,000 is a buffer between you and life, between emergencies that come up, medical stuff. Maybe you get sued. Maybe it's a job demotion at work, just various things like that. You want to be able to ride through any of those storms that happen. So that's step 1 and 2, right? Get your income going, maximize that through active income. Have a big buffer of reserves, because if that happens, you're set. Right? You've got yourself hedged with your day-to-day and your active work. But that's only 2 steps out of 3. And I think why step 3 is really important is, what if you lose your job? What if you become disabled? What if the economy changes? What if any number of things happen where you can't have active income? Right? Caleb Edwards, the co-host of this podcast, talks about his son who had a medical crisis, right? And Caleb's active income just completely came to a halt because he wasn't doing any of that active work, because he needed to focus on his son getting better, and his stock portfolio and some of his investments just completely crashed, right? Because he didn't have step 3 going. And that's kind of what I'm going to talk about now is investing. And I'm the co-founder of a private equity firm. I love alternative investments, oil and gas, multifamily, debt funds, all kinds of different alternative investments in real estate. I've been involved in real estate for like 20 years. I've always been a huge fan. But I think people can get ahead of themselves, right? And they try to say, hey, I just want to replace my active income with passive income. But it just takes time. And I think that it's easy to try to shortcut the process and put too much money into passive stuff too quickly, where then it weakens step 1 or 2. But I think you need to get step 1 going strong, go into step 2 once that's strong. It's like a waterfall, right? It's 3 buckets. Step 1 gets filled up, goes into step 2, fill up those reserves, and then all that overflow then begins to go into step 3, and that's starting to build up your wealth. I don't think having a job is wealth building. I don't think that, even if you're a doctor, I don't think that's wealth building. That's income. That's just day to day. It's monthly. It's maintaining your standard of, even if you're a doctor, you probably have a nice car, you got a nice house, you got nice vacations. That's not wealth building. That's just monthly. That's living, right? Step 2 is not wealth building either. That's your security, right? That's your hedge. Those are your reserves protecting you if something happens to step 1. But step 3 is wealth building. Right? So that's when you're strategically deploying capital to build true wealth. And this is something where a lot of these alternative investments, I've been in this space for a long time, they don't pay out cash flow a lot of times. Maybe you're buying a multifamily property that needs renovations that's going to take 2 years, and you're raising the rents $200 or $300, and you're getting a lot of upside, right? And you're doubling your money, but maybe it takes 4 or 5 years for that to happen, right? Maybe you have a multifamily development where I'm working on one right now. It's a piece of ground, right? There's not even any units to rent out. There's no cash flow from that, right? It's a multi-year process where if you're relying on step 3 to replace step 1, you got to have so much into step 3, right? Like you have to have such diversity in there. You got to have so much cash invested in there on stuff that's paying you current on. My point is this: active income is very noble and is very right. And I think that's the main point I'm wanting to make on this just short episode is, I used to have this thinking too of how passive income, and it's, you see these people 22 years old, 25 years old, influencers, or they're just, oh, I got all this passive. It's like, something seems off to me about that. I think that it's great to have passive income. Who doesn't want that? But I think it just needs to be paired with active income. I think that's how we were created. I think everybody has gifts. Everyone has talents. Everyone has value that they can contribute to the world. And that's why this whole idea of just going totally passive and replacing I don't like it. I think that active income is something that's noble, and it should be something that I think each person was created to do work, to do maybe you're doing the wrong kind of work. There's a process where you can maybe figure it out to get into the right work that you should be doing, right? That's how you were created, your aptitude, your skill set, the propensity for you. But all this to say, step one, make as much money as you possibly can working hourly. Number two, have a lot of cash reserves to protect yourself. Then number three, you start funneling it all into these alternative investments. Some of those investments are going to cash flow current. Some of those investments are going to be wealth building for future. But the more you can have step one going and step two going, then the more you can start putting into step three. If you get rid of step one and you just try to do step three, how are you going to do that? Like, how are you going to get passive income if you don't even have anything to invest into something to get the passive income from? People always are like, hey, I just want cash flow. And I'm like, you know that cash flow, the way that cash flow is calculated is actually, cash flow is a metric that's actually calculated based on invested principal, right? So let's say you're getting 10% cash on cash return and you want to make $100,000 a year. You need to have $1 million invested into that thing, right? If you have $1 million invested into that thing that's giving you the 10% annual to get the 100, you need $1 million. How are you going to get the $1 million? The only way you're going to get the $1 million is by step one. You're going to get the $1 million by active. And so that's why I think unless you win the lottery, you got a rich uncle who's just going to toss you the money. I think that doing it in that order, I've just seen it over and over again, is wise. And I think that eventually step three or bucket three can replace step one, right? Eventually you have more coming in on three than you're actually making. You get to the point where you're like, I'm actually making the same amount of money passive as active. So then you have a choice to make. It's maybe I can reduce my active, right? Or maybe I don't even want to do any of my active. I think everyone should always do active a little bit, even to the day they die. I don't believe in retirement. I think everyone should always be doing some active. I think it's good for mental health. It's good for relationships, for value, for your own, for who you are. I don't like the concept of retiring at 65, but all that to say, this is the order that maybe you guys disagree with me. Would love to hear your thoughts in the comments here, but this is how I do it. And for me, step one, I don't have a W-2 job. I'm a business owner. I own several businesses, but it's the same concept. I want those businesses to make as much money as possible, but they're not passive. I'm working every day in those businesses actively for that money. And then I'm getting those reserves going. And then the excess I'm then taking, because 5-10 years from now, I might not want to be working this hard in those businesses. I want that passive to equal it, right? To rival it as far as the money that's coming in monthly, to then where it takes a lot of pressure off, where it's like, you know what? I may choose to still do the active work because I actually like doing the active work and I don't fully believe in retiring completely, but it takes the pressure off and I can maybe reduce the active work a bit, or maybe take off for 6 months and it's fine because the passive is paying me the same anyways. It's a snowball effect though, because the more of the active that you can throw into the passive, it will start to grow. And then even the passive, all the money that's coming out of the passive can go back into the passive to keep snowballing within the passive if you stay on the active. If you never have to pull from step three and you can keep putting it back in, then obviously that will continue to compound, which is what I do. I got a lot of passive investments and I don't take anything from them. I just let them go. I just let them churn and I keep it all internal because I've got a job. For me, it's being a business owner but in those businesses, I have roles and I just get a salary from the businesses like anybody. who's working a job. And lots of thoughts here, but yeah, just wanted to share this with you guys because I know a lot of people are really excited. And this message goes against maybe of our sales of, hey, come into our alternative investments. But I think you just got to think about everything holistically, right? We're always looking for investors. We have tons of people going into a lot of our opportunities, but we always want to, or at least I want to just present this kind of concept of don't get too excited about, hey, going into this investment, I'm suddenly going to be replacing my income, or I'm going to get rich off it. It's like, hey, nothing's guaranteed when you go into this stuff, whether it's deals we have at Oak IQ Investments, whether it's any operator around the country, nothing's guaranteed. Nothing is going to be an immediate return. And there's a real beauty in active work. There's a beauty in just going out, working, earning, making that money through the hours, and then just being wise about putting it into some of this other stuff. And I think both are super good and both should be pursued. But last comment is just how long it can take to truly replace your income. We try to model our deals usually around a 2x multiple across a 5-year hold period, which means if you put in 100,000 in 5 years, it's 200, right? You throw it back in the next 5-year cycle, it's 400. But it's been 10 years now. Then the next 5 years is 800. The next 5 years, it's 1.6 million. 1.6 million, that might be, you got a chunk now. Where if you put that into, we talked about 10% cash on cash return, maybe you got 1.6 now that you're getting $160,000 a year in passive. So you probably replaced step one, right? Or definitely chipped into it depending on how much you make. But that's 20 years. But you can accelerate that process by getting step one stronger, or maybe you're putting 200 in, 300 in to the passive stuff and letting that compound. But if you quit step one too early, then you shortcut that process. And so these are just my thoughts. Appreciate any comments or feedback you guys have. Thanks again for tuning in for another episode of Own the Exit. I'll see you next time.